Alternative risk transfer products are basically derivative-based products that help us take on a risk that a bank or insurance does not like to have on their book and allows us to match their exposure in a way that we can make a profit from holding this product. It might be a certain volatility that the bank does not want to be short or long, and our fund can make a profit by buying or selling this kind of product. What we do is we calculate the sensitivities of each and every transaction or every position we have in our funds. So on a daily basis, we know exactly what's our delta, what's our vega, what are our Greeks, our sensitivities to market risks. And then we can easily use liquid positions in stock exchange markets to decrease or increase exposure to certain strikes, to certain volatilities, to certain deltas or vegas. One of the key takeaways from the panel discussion today was that people are still interested in how this really works. How do you really make a profit from facilitating unwanted risks? And another primal point of the discussion was, how do you manage the risk arising from that? How is the liquidity from these positions? And I think the key takeaway was that all the panelists are dealing with the risk in a pretty similar way. Clear risk measurement, clear risk management by position sizing and hedging activities. Buy-side and sell-side view one and the same product clearly differently. First of all, the trading capabilities are different. Things like daily or minutely delta hedges are no problem for a large bank, but it is not something that fund managers are set up to do. Fund managers are much more focused on holding positions over longer time horizons, taking market exposures, taking market risks in a useful way for their fund to generate returns, while the bank is more making profit from bid-offer spreads, from providing bid offers to clients, and in an ideal world wouldn't have any position at all, while the fund manager clearly wants to have market exposure, clearly wants to have exposure. When we talk about opportunities in that sector, one of the most asked questions from my clients is, what do you do if you run out of opportunities? And honestly, I've been running these kind of funds for now 12 years, and we never had the situation where we run out of opportunities, simply because banks and insurance companies are always having some kind of products they are pushing. The retail business is always generating exposures. So today we have opportunities in the rate space, in the FX space, in the equity space. If one risk factor is not attractive anymore because too many market participants are chasing the same premium, we just move on to the next topic or to the next asset class and find 5 different topics in there. So it's not really a problem to escape a crowded trade here. That's very different to stock exchange trading. On the stock exchange you have one thing, and if it's crowded, and you have very little alternatives. In the risk recycling space, you have so many different risks you can turn to. We are having this conference here in Munich, and Germany is one of the very large players in the interest rate derivatives markets. The German market participants usually don't like to trade derivatives on a large scale, but they have embedded it in their callable bonds. In fact, Germany is one of the largest purchasers of callable bonds, which gives a steady short volatility flow into interest rate derivatives. So there's an ongoing opportunity to purchase very cheaply long-dated interest rate volatility for funds like our opportunities funds. We can easily match or find liquidity in the market because all the banks are positioned in the same direction, because all their clients are buying callable bonds, therefore selling volatility, therefore feeding us with very cheap volatility, with cheap hedges.